Today, we're diving into the high-stakes world of banking compliance to talk about a deadline that, well, isn't really a deadline at all. We're talking about HMDA reporting. It's a requirement so intense, the pressure to get it right feels like this constant, never-ending cycle. So, let's get into it. So, let's just start with this. Kind of a mind-bender, right? What if a deadline wasn't just some date you circle on the calendar, but instead it was this constant, year-round pressure? Sounds a little wild, but believe it or not, for anyone working in mortgage compliance, this is pretty much their everyday reality. You see, while the official submission date for all this HMDA data is March 2nd, the real work is anything but a last-minute sprint to the finish line. Oh no, it's a full-on marathon. The pressure to maintain perfect, totally defensible data is a constant, year-round thing. Okay, so what exactly is HMDA? Well, it stands for the Home Mortgage Disclosure Act, also known as Regulation C. And to put it simply, it's a federal law that makes banks collect and report super specific data on every single mortgage application and loan they handle. And the whole point? It's to make sure everybody is getting a fair shot. And this is where things get really interesting, because the game has completely changed in recent years. HMDA compliance isn't just about checking a box anymore, not even close. Now, it's all about being ready at any given moment to defend the accuracy and the integrity of your data against some pretty intense regulatory scrutiny. So what happens if that data isn't perfect? Well, the stakes are higher than they've ever been. Let's break down exactly why even what seems like a minor error can spiral into a massive headache for a financial institution. Just take a look at this number, 38%. According to the Federal Reserve, in 2024, violations of HMDA, or Reg C, were the single most reported consumer compliance issue for state member banks. We're talking more than a third of all violations cited. That's huge. And check out this quote from the FDIC. What's so fascinating here is that the most common mistake wasn't some super complex financial error. Nope. As you can see, it was as simple as failing to provide sufficient data. It just goes to show how fundamental and how common these data collection errors really are. Now, you might have heard some talk about deregulation, maybe a little whisper that compliance relief is just around the corner. But the reality on the ground? It's a totally different story. Regulators rely on this HMDA data for just about everything, from fair lending exams to big policy decisions. So trust me, that scrutiny isn't going anywhere. And all this pressure creates some serious challenges, especially for smaller community banks. Their data is often scattered all over the place, in emails, in manual spreadsheets, across different systems. This makes proving their controls are working and making sure the data is accurate, well, it's a total nightmare, and it puts their credibility with examiners on the line. So with the stakes getting higher and data all over the place, how can banks possibly keep up? The answer really lies in a big shift, both in strategy and in the tools they use. Let's dig into how automation is becoming the modern solution to this whole never-ending deadline problem. And that really gets to the heart of the mindset shift. Automation helps banks move away from that frantic, last-minute panic to get all their data validated. Instead, it transforms compliance into a manageable, continuous marathon where data quality is being monitored all year long. Of course, automation is a great buzzword, but what does it actually do in this situation? How does it really work? Let's break it down into 4 tangible ways it completely transforms the HMDA reporting process. Okay, so first off, it slashes risk by catching errors right away when the loan is being created, not months later. Second, it lets teams focus only on the files that actually have errors. We call that an exception-based workflow, and that saves a massive amount of time. Third, it creates one central, locked-down data set, a single source of truth. And finally, all of this works together to seriously enhance quality control, which in turn boosts an examiner's confidence in your data. It's a win-win. So this is obviously a big deal for bankers. But why should it matter to the rest of us? Let's zoom out for a second and connect this to the bigger picture. Because believe it or not, the quality of this data in our financial system really does have an impact on everyone. You see, accurate HMDA data is basically the bedrock of fair lending. It's what protects consumers from discrimination, it helps regulators keep our banks stable, and it even informs long-term economic policy. When this data is clean, it's a sign that communities are being served equitably. But when it's flawed, it can hide some really serious systemic problems. Ultimately, this is all about fundamental trust and fairness in the entire system. So if there's one crucial takeaway here, it's this. In a regulatory world where change is literally the only constant, trying to rely on outdated, manual processes just isn't going to cut it anymore. Modern tools like automation are absolutely essential for banks to adapt, stay secure, and operate efficiently.
And that leaves us with one final thought to chew on. As our world becomes more and more driven by data, is embracing technology like automation no longer just a matter of efficiency, but maybe the only real path we have to ensuring integrity and maintaining trust?